Well, howdy, folks. It's Mike again, and welcome to volume two of our Dirty Volume series. So, hopefully, you watched volume one, which was episode 57. But if you haven't watched that one, you could probably still watch this one and then go back and watch that one. But I'm going to do these with the assumption that you have the knowledge from that last one. So if you need that knowledge, want that knowledge, would like some extra sleep, go back and watch that one. I'm going to try to make this one shorter, but we'll see. There's no plan. There's a general plan of some of the things we're going to tackle today. So I wanted to tackle volume on an index level. So a consolidated tape. So think NYSE volume or NASDAQ volume, and that's used for follow through days and distribution. So we need to address that. And then we'll talk about how kind of where I started going with this, why I started looking at volume being dirty, but also what we're going to talk about. Now let's just start it with this topic, and we'll see if I even remember what I said I was going to tackle. If not, we'll do that on another episode. Again, this is going to be a series on volume being dirty. So before I get into any of the specifics, just a little bit on this. Years ago, maybe a decade ago, I started recognizing that volume had issues. And that as time went on, I realized it had really serious issues. And I felt that the data was dirty. And when you're dealing with dirty data, it becomes a crapshoot. And so what happens is you're like, oh, when it's good and it fits your thesis, then you go with it. And when it's not, you're like, oh, well, that's okay. It doesn't have volume this time. Well, that just doesn't fly with me, man. You either have rules or you don't have rules. Now, you can have some things that are nice to have, but you can't say that volume is super important and that you're going to use it, but then discount it sometimes. I just don't buy that. Like, it just does not make any sense to me. And well, let's get into why I kind of started going down that road, and we'll just see where this goes. And wherever we don't get to today, we'll do on another episode. Because again, I started telling people that I thought the volume was dirty, and I stopped using it, which I don't use volume at all, with a few small exceptions. So one that we probably won't talk about on this episode, but on future episodes is pre-market and post market. That volume I do look at for various reasons that we'll get into. And then I look at the overall dollar volume that a stock trades as a sign of institutional sponsorship, as well as just general liquidity, because you don't want to get trapped in something that's too illiquid. So we'll talk about those separately, maybe on this episode or maybe on a different one. Wanted to go with that thought that I was saying of where this started and where the problems were, that even when I thought volume was still clean and I hadn't really made this change of not using volume, it was really problematic. So there's a couple things. First, we'll talk about the model books. So everything that Bill did, and you can find it in his book that everyone should get, How to Make Money in Stocks. No, I don't get paid a penny for it. Yes, I did help a lot. And with versions 3 and 4, or editions 3 and 4, but that's okay, man. It was a privilege. Like, this book changed my life. I want to say episode. The edition 2, that that completely changed my life more than anything as far as like business or non-family related. It changed my life. Kind of like hearing Hendrix for the first time, or Guns N' Roses for the first time, or of course Eddie for the first time. It really, when I got his first the book the first time, it really changed everything, and sent me on a direction of wanting to work with him. And there was no plan B. Like, I switched jobs, took a pay cut to go work in his research department. And on February 3rd of 1997, it's February 8th, 2026 right now. So I just had a little, 29th year anniversary of when I started there. And it was a privilege to work on the other edition. So what we did was put in the front of it all these pages of these models that are so important to everything that Bill did. And I had the privilege of building the models from my first model I built with Ross Haber, just a great guy, and Chuck in 2000, and that was what we called the bubble book, and that was from 1997 to 1999, and I've discussed that in lots of those charts are in here. Discuss that on prior episodes, and then after that, Chuck and I just did all the other model books going forward, including one from the 1880s. That's a big topic, and I've talked about that in a couple of different episodes, but that is where a lot of this stems from too. It is from, shoot, man, we've got to go down these paths, otherwise you won't understand. So there was a place where I was going, and we're going to have to go this other place. Sorry, we got to do it, kids. So Bill had built everything around the models that you see in here, and his formula that I'm not allowed to say because at IBD we don't own it, so can't say the words of the chapters that are in here, the acronym, or we could get sued. So that's freaking hilarious. I mean, I'm not even going to go down there, but that's freaking hilarious. But with this point, he had built his career off of really studying things from the late 50s to wherever current time was, because he was building models when I was just a little baby. When I would trying to think of, yeah, he probably built that first model book that I've shown in prior episodes. That it was his prototype and his first one that he gave me. That one was probably before I was born. So this is the style of how he would approach things. And what it was just looking at reality, which was stocks that had big moves, and that was a model book stock. And then studying at the very beginning of that move, what did it have in common, both fundamentally and technically? Now, on this channel, we typically are talking technicals, but fundamentals are a huge, huge, huge part. And we'll have to do, no, I did some episodes on fundamentals. What am I talking about? So we have the whole fundamental series, I think, where I plan on doing it. Man, I am maxed out right now. My mental capacity has never been where it's at right now. Like, I am maxed out to the point where, like, I wanted to stop doing these for a while, but I can't, because I'm on a mission to really take what's in here and put it out there, because I want to have this left for my kids and future grandkids. If my kids, who are 24 twins, if they ever have kids, which I hope they do, no plans right now, and those kids ever want to learn how to trade, I want them to learn from this channel. That's what this is about, and that's why I do these in the format that I do, which is rambling and more conversational. Well, not more, 100% conversational, not planned, just as if I'm pretending like I'm talking to my grandkids in the future if I'm not here. So if this is your first one, that might clue you in on why I'm not to the point. And I have friends DM me, and they'll say, "Well, Mike, you're hurting yourself by putting these out there, and you've just got to. What you said over 2 hours could have been said in 2 sentences." Well, frick, piss off! You're my friend. Stop saying stuff like that. I'm gonna do it my way. I don't need that. Don't tell me that again. I don't want to hear it. I'm gonna do it my way. And if you don't want to watch, don't watch. I don't care, man. This is for my grandkids. So sorry, but clearly that bothered me. I know these people mean well, but I don't take it that way. Shoot, I'm having technical problems. Just one sec. We had some technical problems. As soon as I started going on my rant, my computer started giving me issues. So maybe it was someone's way of telling me to stop going down that negative path. So thank you. So let's move into where I wanted to go at first. And that was where this started. I was talking about the models and everything. And so everything came from the model books. And I would do all those models Chuck and I would do. And we went back and did from the 1880s forward. So what Bill had done is from really the late 50s until every so many years, he would have his PMs build a new model book. And then when I was a PM, then that became my role along with Chuck. And so we would just build it for, every 3, 4 years or so, we would put a model book together, and it would take a lot of time. I mean, it would take us sometimes a year plus to build one model book because there's a lot that went into it. And one of the things was selecting the pivot date. That was probably one of the most important things. And this became a problem because you got to remember, Bill wanted to run stats on everything. From a fundamental standpoint, what did the earnings look like before it had its big move, or technical stuff? What was the RS line? What was in later years? What was the composite score? Whatever it was, he wanted to look at the stats at the beginning of the move. The beginning of the move was super important to him, and it is to me as well. But what you want to remember is it's not just about the initial move, because you might miss that for one reason or another. And there's all the way, let's say it breaks out in January and goes for like a year and a half, because most of them, like on average, they go a year and a half, some shorter, some a lot longer. And it depends on how you slice it. But you might not buy that, or you might buy that and then get kicked out of it one reason or another. Either you made a mistake or it gave you a sell signal and have to get back into it. So it's not just about that important first day. That's super important, that first day and the first week, but it isn't everything, which will be kind of topics for future episodes. We might do, okay, what happens when you miss the initial breakout, and how do you get into it? Because that is a big, important topic that would probably warrant its own series, but we're going to stick on this series for volume. So we would build these models and study it. And so when Chuck and I would go in to find the initial date, first we would do it on a weekly chart, because that's what Bill cared about the most, was where was it on the weekly. So then we would isolate the couple points where you could start it on a weekly. Then we would have to go into the exact date and find the exact pivot price on there, which wouldn't necessarily be a standard pivot. It could be an alternative pivot, meaning a standard pivot. And on this series, I'm not going to assume any prior knowledge of our system or how we do things. So anytime I get into something, I'm at least mentally going to try to explain what I'm talking about, because I know not everyone who's watching this has read Bill's book or has traded our system for a while, currently called the IBD methodology, no longer that other thing. So I don't even know what that is anymore. I've forgotten it. Someone else owns it. Couldn't possibly remember it. But sorry, just gotta have fun. Like, you can't keep this all boring. And like 3 or 4 people understand what I'm talking about. So anyway, still trying to break that habit of saying anyways, but what are you gonna do? We are going to kind of focus in on, like, where was the problem? So we would look at the exact pivot day. This is where it became a big issue, because we go through there and go, okay, well, here's where it gave a clear alternative pivot. We would have wanted to buy it there. But many times the volume rate wasn't there. Okay, so what is a volume rate? Volume rate is the key way Bill would look at volume on a daily chart. And that was the volume, how much above average it was for itself. So he would always look back 50 days. And I think that makes sense. You got to pick something, so 50 days is as good as anything. And then it was used that in a lot of things. So our up down volume was off of that, or a lot of our default moving averages are 50 days, and 50 and 200 were his go-to, which would translate into a 10-week and a 40-week if he was on a weekly chart. So he would want it above, with a volume rate of 50% or higher. So what does that mean? A volume rate of 0 would mean it's average volume. So if the stock traded on average 100,000 shares a day, and on the breakout day it was 100,000, well, then it would be a volume rate of 0. If it was 150,000, it would be enough. It would be a volume rate of 50. If it traded 200,000, it would be 100% volume rate. And if it had only traded 50,000, then it would be a minus 50 volume rate. So this volume rate becomes very important, because he would always say the volume rate on the breakout has to be 50% or higher. This is the first problem I had with volume, even when I had no concept that volume was dirty. that we would have to change the pivot because we go, oh no, Bill's not going to be happy about this because we're showing the volume, the pivot price is breaking out here on Wednesday and the volume rate is minus 25. And we don't have a 50% volume rate until the following Tuesday. And at that point, the stock is extended. So what do? I mean, this was a big problem. Like, this is not a trivial problem. This was all the time problem of trying to figure out the one data fitting, what Bill wanted, because we would try it the other way. Like, okay, here's when it broke out. This is what the volume rate is. That's how I would do it. Just calling it the way I see it. That's clean data. Making it fit your mold is not how I would do it. Let's just put it that way. But that's what we did because that's what Bill wanted. Just telling it the way it is. Love the dude, but just I don't agree with a lot of the approach. And he was also fine with the super small sample size. That was one of the kind of, I don't want to say disagreement because he knew what I thought, but he didn't care. Like, he would just want, if I wanted to study something, I'd want to study it on a full data set or a very large data set. He'd say, no, just take out the model book, the thin black model book is what we call it, which was it was a best of models. So we had all these model books, and then he picked his favorite ones from each one, which were kind of the monster movers. So it was kind of the super duper stocks, which was the right way to do it. I totally agree. But to have a subset of like the best of the best, he would say, well, take the first 10 stocks in there and run it on that, whatever your theory is, because we'd always have ideas like, oh, what if this, what if that? I'm not talking volume, I'm talking anything. It was try it on that first 10. And if it doesn't work, abandon it. Dude, I mean, he's a billionaire, not me, but man, that just didn't fly with me. Like, it just didn't fly with me. But I'm just telling it the way it is. So again, he was a billionaire, not me. So follow the 10. I understand where he was going with that because it was kind of simplicity. He's like, okay, well, if that didn't work there. But the reality is, when he was doing it, he was the king of or statements. He would say, well, if it didn't have that, that thing that you wanted, well, maybe it had this other thing. So then it would become an or statement, which I think of in terms of an or, and he would too, but that's not how he would necessarily direct the research. So an or statement is a very important concept, and it's at the heart of pretty much all that I build, or is these, it either has this or that. The famous one would be, Bill would say, okay, return on equity has to be 17% or higher, or the margins would have to be blah, blah, blah. And he just always thought that way, think that way, and it makes a lot of sense. The more of this type of work you do, the more you realize that there isn't a set thing. So when he would tell me just try it on the first 10 and then I would have to abandon it, well, I stopped asking him because I didn't like that, because I knew that there was this or statement. There was a possibility that those first 10 of the super models, it would need an or statement. It didn't have this, but it had this other thing. So then you could have an or statement, say, well, it either has this or it has the other thing or the other thing or some other combo. And that's the way the market isn't as simple as 10 super stocks are going to have all the same thing. It's just a reality. And I've spent my adult life studying these. So I'm just telling it the way it is now that I can. So this was a big problem. We would have to go in and we say, okay, well, let's give it to him this way. And then he would look at it and say, well, no, the volume rate is minus 30. That's not right. And the volume's got to be there. So it was important on a daily chart, but even worse on a weekly, because on a weekly volume, he insisted that the volume on the weekly did not have to be above its average. We'd also have a kind of an average volume line, a 10-week average volume on there to see if it's higher or lower than average, but it had to be higher than the prior week, period. And so a pickup in volume from the prior week, whether the prior week's volume was light or not. And one day, well, this is probably where the whole questioning volume thing happened, is I asked him a question on that because we were really having problems. Because look, first, to build a model book, first you have to go through a time frame. Let's say you're building a model book for 2023 to 2026. Well, you start off by what went up the most. That's your your first thing. Then you'd filter in and go, okay, well, then which ones went up the most that you'd want to study? Like if something got bought out or it was a biotech without earnings that got FDA approval on something and went up a couple 100% and then got a short squeeze in it. Well, that's not what we're studying because that's not what we're going after at all in any way, shape, or form. We're going after growth stocks or turnaround stocks, which are unique. And you would always have, give or take, like a quarter of the stocks in the model book would be turnarounds, and the rest of them would be growth stocks. Sometimes more, sometimes less. Some of the model books were more like 95% growth stocks. It just depended on what was working during that time frame. Then you go through, and as I've talked about on prior episodes, there were things that were like no go. If the stock didn't have earnings the way he wanted to see it or sales the way he wanted to see it, it wasn't included. So you were already removing out reality and just going in, which is fine if you realize that you're looking at the subset that way, that you're saying, okay, I'm going to only look at ones with the profile that I like. But then you can't say that this is how it works for all stocks, because no, that this is how it works for growth stocks. And that's how I look at it. And I square that by saying, okay, well, for the growth stocks, as we look at growth stocks, these are the best of the best. Those are your models. You could have other stocks that run up and don't have that same profile, but they're going up on something else. And there's lots of those other categories that they can be going up for. And that's fine. I don't have a problem with that. It's just how you look at it and how you phrase it, but that's not for me to say, really. Well, I don't know. That's a different topic. So you're going through and you're saying, okay, from 23 to 26, these are the ones that have the biggest run up. And then you do a quick move through and you remove all the things that just don't make any sense and weren't liquid enough for you to trade and all of that. And then you get it down to a smaller group of stocks to study. And then you look at the ones that fit your fundamental mold, and it's a smaller sample. Then from there, you're going in and trying to pick where to buy these. Now, he would want the earnings to be positive. So your over-year quarterly earnings would have to be positive, and the 4-quarter trailing would almost always have to be positive, or certainly the most recent quarter earnings itself, the actual earnings, not the year-over-year percent, would have to be at least a penny before he would even consider. So now you have a subset of a subset of a subset. And then from there, this is where the real problem comes. Okay, so now you've got your universe, and this is why it would take Chuck and I a year or two to do this, because we were doing this in addition to anything else we were doing. So then you have this small subset, and then you're saying, okay, well, I need to find this pivot because that's what everything is built off of, that pivot. The top is a lot easier. That's simple. Well, Chuck and I came up with some rules to make it simple because it was complex. We'll talk about that in another episode. This is supposed to be on volume, and I'm getting there. Trust me, I'm getting there. And the reason for this. So this is why you got to understand kind of where I'm going with this. We're searching for models to study. We've looked at everything. We've brought it down to our small subset. Now we've got to go in and say, okay, on this day, this exact price is where it was the pivot. That was your inflection. Everything is around your pivot. At that pivot, what did all the fundamental data look like? What did the group look like? What did the market look like? Everything else. It's all built around that. That's how you get a clean data set. Well, not so clean, but it is what it is. It's clean depending on how you want to look at it. Some people he would look at it as super clean. I just have a different take on it. That just, it was a subset, nothing, not dirty, but just a subset. So now we are trying to figure that out. But we know that two things have to happen to make Bill happy. The volume on the weekly has to be higher than the prior week. And on the daily, it has to be higher than 50%. Well, what the heck? That's not the real world. I'm just telling you because I've studied it and I'm letting you know that's not how it works. But this is where the conversation that I had with him that really kind of started me going down this path to not use volume as a hard and fast rule to buy, because I looked at the data set and I looked at all of them and you would miss them because you would by the time the volume would fit what you would want, it would be too far extended. So the other thing would be, you're not supposed to buy a stock more than 5% past its pivot point. Well, many times a pivot point, by the time that volume would kick in, it would be way past 5%. So then what are you going to do? And if you can't buy it at the pivot, what's the point of the study? Like, really, what is the point if your rules aren't going to get you in there on this subset of a subset of a subset of a subset? What is the point? Oh my God, it drove me crazy. And so to try to get him to bend, I would subtly ask him questions to get him, because lots of times what you would do with him is you would just kind of plant a seed, because he had to come up with it himself. So you just kind of plant a seed, and then if you didn't, it was a good Ronald Reagan quote, and I'm just going to butcher this, but it was one of my favorite, and he was a huge Reagan fan. Like when we shared an office together, he had two things in his office. One was a beautiful portrait of his favorite dog who had passed away. It was like a Lassie type of dog. And then also a picture of him in the office, the Oval Office with Ronald Reagan, because he helped out behind the scenes with that. And that's a topic for another day. But he was a huge fan of Reagan. Like, I think that was probably his favorite person was Reagan. I don't think there was anybody else that he had more admiration for that I can think of, way more than for a Darvis or a Livermore or a Baruch or a Loeb or any of those people. So I think it would have to probably be Reagan. And Reagan had this quote that I loved, was something to the effect of, you can get anything accomplished if you don't care about who gets the credit. And I took that to heart. And so a lot of the work I did behind the scenes is like, I didn't care who got the credit. The guy on with the name on the building or whatever. I was just trying to help. I got to stop with these tangents that don't have to do with volume, so I won't go. So if you didn't care, I would just plant these seeds knowing that a week or two or a month later, it would trigger, and that would happen all the time. And then he would say, well, Mike, I really think we should look into X, Y, Z. And it would have been, what I'd asked him before. But because if I would have said to him, hey, Bill, I've studied this thing and I really think we should do this. And he would say, no, Mike, that's all wet. I've studied that already. So you had to know how to, I love that part about him, because you could just kind of see how you had to deal with it. And it was just cute. Yeah. And it's like, I didn't have any ill will towards that at all, because it was just, once you got to know that that's what was up, and then he would come back and he would completely have forgotten that you're the one who planted that seed. And I was just happy to be working on it, because I would run into that brick wall if I said, hey, Bill, I have this idea that blah, blah, blah. Now, some of those he would be fine with, but if there's any, I would know what to ask him. Like if it was within something that would be in the book, in that basic concept, it's free game. But if it was something that was outside of this, it would be considered off the reservation. But you got to remember, he had his first edition, then his second edition, third edition, fourth edition, and it kept on changing. And then he had his successful investor that I also helped him out with. And that took things differently. So he was open to change. I know this is being long-winded. It is what it is, because otherwise I'm not going to be able to explain like why this bothers me so much, this volume thing. So we now have the subset of a subset of a subset of a subset. And now we're looking at it and we're trying to have this extra variable on there, that the daily volume and the weekly volume. So this was the thing that I've been trying to say. I ask him this, again, trying to plant a seed to see if he'll change his mind, that I said, well, Bill, we're doing this, picking the pivots, and you're insisting on the volume on the week has to be higher than the prior week. Are there any exceptions you're fine with? He looks at me, Mike, no excuses, no alibis. The volume's either there or it's not. Now that's word for word. And so I wanted to start like putting these seeds there to see if he would come up with exceptions in his own or statement. I'll fast forward. He never did, but I would say, okay, well, Bill, what if the stock breaks out on Friday and all week it's been light volume all week? Now, got to understand what I'm asking him about. He is hard and fast. The volume, the total volume for the week of the pivot, the breakout week, that has to be higher than the total volume for the prior week. No exceptions. Zero exceptions. No excuses, no alibis. So I'm trying to get him to bend on this. And so I said, well, Bill, what if it broke out on a Friday and all week it was light? Well, first I started with a Wednesday. What if it broke out like midweek and earlier it was light? No excuses, no alibis. Then I go to Friday. I go, what if it breaks out on a Friday and all week was light? No excuses, no alibis. Then I proceed. This is a true story. Like I remember like it was yesterday. And then I asked him, like, okay, how do I get to this point where he's going to connect these dots? And I said, well, Bill, what if it breaks out on like around Christmas or New Year's on a holiday week? And so the volume, if you don't understand volume around holidays, it's extremely light. Like it's the go back and study. Yes, around like 4th of July, Labor Day, and all those other ones, you're going to have a Memorial Day and stuff. You're going to have some volume light. But remember, most of those are US based. But when you start dealing with Christmas and New Year's, it's pretty much global almost. So that whole time frame, everything's volume is light. And so I said, okay, he's going to pick up on this. I said, okay, well, Bill, what if it happens during a holiday week, and so the volume's already going to be lighter than than the prior week, so we're going to have that bias. Mike, he starts getting upset. Mike, no excuses, no alibis. So I try one more time, and this is when I gave up. I think he was getting annoyed with me. I'm like, okay, like kind of like the kid in the car, like, and my kids never did this. So I had the perfect kids, and they would never ask me, where are we here yet? Are we here yet? Like it was just really perfect. But you always see those in movies where, are we there yet? Are we there yet? And there's a movie called Are We There Yet? It's pretty funny. I think it's like, I don't know who's in that. Somebody funny. I like that guy. I think he was a rapper. Or, I don't know. But anyway, I'm telling you, I'm maxed out. I'm really maxed out. So I ask him, I'm like, okay, Bill, what if it happens on Christmas Eve? And Christmas Eve is a Thursday. So the last day of the tree, because Christmas Day would always be December 25th, would always be the market is closed. And then Christmas Eve, it always closes early. So you have a half day. So volume is always like that day. So I said, what if Christmas falls on a Friday? So you only have 3 days, Monday, Tuesday, Wednesday of full trading, and then you got Thursday as a half day and Friday is closed. And you're looking at your volume versus prior week, and that's the time that the stock breaks out. And you are like saying that it has to be, the volume has to be higher than the prior week. Otherwise, it's not a model book stock. Even if it went up 1,000%, like, it's, oh my God, this is like funny as I'm thinking about it. And so I asked him that. I said, well, Bill, what if it happens and it's a Thursday, blah, blah, blah. And he looks at me all annoyed. He said, Mike, now listen, no excuses, no alibis. It's either there or it's not. End of the story. And I didn't ask him any more questions, man. He was pissed. So that's how we looked at volume. There was no excuses, no alibis. Now, fast forward to a follow-through day that happened to be on a Columbus Day, which was a full trading day. And this kind of explains how, as long as he came up with it, it was okay. So volume on a follow-through day has to be higher than the prior day on a daily basis, has to be. But on Columbus Day, the bond market's closed, but we're open, and there's all this activity between the bond market and the stock market. And so when those players aren't there, you get a natural lowering of volume. Same thing on Veterans Day. The bond market is closed because they care about our veterans, and the stock market is open because, and it's ridiculous. So on those days, you're always going to have this tendency to much lower volume because of that interconnection between the bond market and the stock market. So that activity isn't there. So it was Columbus Day, and we had a follow-through day. I can't remember what year it was, but it was sometime over the last 20 years. And we had this follow-through day, and he called it. Like none of us could have called it. He said, well, volume would have been higher if it wasn't for the holidays. So we're going to call it a follow through day, which I had no problem about because that is, but I was asking the same question for the model books and no excuses, no alibis. So that's where I started going with this, started thinking like, how are we going to get rid of this volume thing? Because that's great if a capture is 80% of them, 70% of them, 99% of them. But what if that 1% is that game changer for you? And that's just a weekly volume variable. Now, it was the same thing on the daily side of things that you had the volume rate had to be above 50. Like 30 wasn't even good. Plus 30 wasn't good enough. He wanted it to be plus 50. Now, there were some that we would get through. So there were some exceptions, but it would be more like if he didn't really happen to, maybe he was in a good mood or didn't notice it, or he really something else about it. But that weekly, he wanted that volume to be higher than the prior week, and the volume rate on a daily, he wanted it to be higher than 50, and really much higher than 50. So that's kind of where the whole thing originally started, was just realizing that even if volume was clean, and that was back when I thought volume was totally clean. Like I didn't even remotely have this thought that volume was dirty. So that was a problem. Then fast forward probably a decade from there, and this was around like the 2014, 15, 16 timeframe. That was when I was focused on building algos for the firm. And I built the first algo that we went live with, kind of a proof of concept. And that was a full black box algo. And it took me a lot of time to build that because I built it in a way that, and I explained it to my programmer that I was working with. As I said, you need to build this to assume that you have all of your money, all of your friends' money, all of your family's money in there, and you have no connection to be able to turn off the computer or do anything. Once it's going, it's all in there. It's all, and that's how I approach it. Well, that's how I approached it. I'll just say that. And so with that, from the logic standpoint, I had to account for everything and in things that had never happened. So it really gets you to start thinking outside the box and just going, okay, well, what if that stock does break out on a Thursday and it's Christmas Eve and it's a half day, and the news that gets it to, and that was the other thing that I asked that I said on there. I said, oh, and Bill, right before the close on that Thursday, some news comes out, material news that comes out that breaks it out, but it doesn't have enough time for the volume to get high enough to be over on the weekly basis versus the prior week, because you have 3.5 days worth of trading versus 5 days worth of trading. Plus it's a holiday week and the news comes out late. That is what he just did not like. And look, what would he do in that case? He would buy the stock. I know him. He would buy the stock. But when you're writing rules and studying history, he wouldn't be for it. And so that's what was a real problem for me. And it got me thinking, okay, well, if we don't deal with volume, then it makes it much cleaner. And then we would know what is the true volume rate that you need to work. And before we get into talking about the algo thing, I want to talk about the study I did prior to that algo thing of why I ended up going down that road. So it took as I've said, it took about a decade to build the pattern rec that you see in Market Surge. And that was done for my purposes, was to build a big study so I could study the full data set, because it really drove me crazy, this 10 stock thing that we would do. So I wanted to study everything. And by everything, I meant our complete database. And so we went back to 1963 was the complete database at that point, forward to 2013, and I studied all the breakouts. And it was anything that would break out above $10, and I excluded the lowest 10 to 20% of dollar volume. And I discussed that in the last episode. And so this data was then super clean and was everything, because every base breakout in there was looked at through the computer, and I was able to aggregate that data and look at what was the volume rate on these breakouts. And I'll tell you that during that time frame, a volume rate of 200% plus was one of the key things leading to a model book move out of these. So from an automated standpoint, I'll say it again, a volume rate, I think it was like 220, but let's just call it above 200% on the breakout day was one of the most important items. I think the only other thing that was more important than that was the relative strength in number. Yeah, I don't think there was anything else that uh, was more important than the volume rate. But then what I would do is look at all the ones that didn't have that volume rate. Maybe it was 190, maybe it was 180, maybe it was 30 or 40, maybe it was negative, and they went on to have these big moves. And that got me thinking, like, okay, if you're waiting for that volume rate, even though it has such a high predictive value, that there's going to be all these exceptions. And are you comfortable with missing those? And I wasn't. And so now fast forward a couple of years when I was building the Algo, around a lot of this information that I learned from this big study. And so I didn't want to lean on that volume rate, because if I did, I was going to miss this subset of all these stocks that had these huge moves. And I didn't, and it was basically buying it on the breakout as pattern rec identified it. And that was the core part of this thing. And I realized, okay, if I eliminate volume on there, then, or I keep a volume requirement of 200% on there, it's going to be very problematic. Now, the other thing, and this is kind of the most important part of what we're going to be talking about. And so you want to kind of understand where I'm at. So if you've like tuned out until now, let me just summarize where we're at. We were talking about the models and how everything is based off of the models in Bill's book. And then we were talking about how that's a subset of all the stocks that have had this big move. And then we were discussing how important he would look at volume on a weekly basis, and that volume had to be higher than the prior week, as well as the volume rate, meaning on a daily basis, the volume rate was more than 50% above average. So volume rate of 50% or higher. And I agreed with all those, by the way. I have no disagreement that those are important. I just know that there is all these exceptions. Even if it was a small amount, medium-sized amount, there were a lot of exceptions that you would miss with that. But he was fine with that. So now I'm building this algo that is a real money algo that is going to operate in real time, buying stocks as they're breaking out using my pattern rec. And then a bunch of other rules and logic that I built, 100% my logic. And, they sunsetted this. It was kind of a proof of concept. And they had some data scientists come in and build some other algos that they felt comfortable with. But to do this, my decision was, okay, how am I going to approach this? So I've got this pattern rec. Let's say the pivot is 51.5. And that's what the computer says is 51.5. And now it has all these other requirements. So stock, we're going to call it 1, 2, 3, because it can't say XYZ anymore. So this, or we'll just call it stock. Yeah, stock 1, 2, 3. So that stock is now breaking out through its pivot of 51.50. And you have to decide, is the computer going to buy this or not? And it's already on any of the fundamentals or the technicals, it's already said this is a candidate and there's room in the account to buy this. So therefore, if it goes through this, what are you going to do? Are you going to buy it? Let's say it goes through your pivot 15 minutes into the market. Are you going to buy that? 5 minutes into, 1 minute into the market. Are you going to buy that or not? Huge problem. Can you see the problem? You have no clue what the volume rate is at that point after the fact. So let's say it's going through its pivot in the morning. Let's just say the first hour of trading, it goes through, and now it's going through that pivot right now. And you've got to decide, do I buy it or not? Let's forget about the intraday volume rate. We'll table that for now. You don't know your final volume rate until the market closes. So you're saying that I want a 200% volume rate on day's end. or 50%. Let's just call the bare minimum 50% volume rate at day's end, but it's only an hour into here. And I don't know what that volume rate is unless it's already traded that many shares on a daily basis with the assumption it's not going to trade any more shares the rest of the day. Well, that's going to be super restrictive and probably nearly impossible to get that volume, that amount of volume, unless it's an earnings day that early on. And if it's an earnings day, it's probably blowing way past that pivot. So what are you going to do? Are you going to buy that stock or not? And that was a dilemma I had, because I knew at that point, and I wasn't into my dirty data, volume being dirty at that time. It was a thought. It was a little baby thought, but I wasn't, this is, again, a little over a decade ago. So that's like the 2014, 2015, 16 timeframe. So I'm having to make this decision. Well, what do I do? The stock is breaking out in the first hour, and I don't know what the volume rate is going to be at the end of the day. Do I buy this or not? Do I have the computer buy it or not? What do you do? Well, you have a few choices. You could either pass it up, you could buy some of it and wait until the close and buy the rest, or you could ignore the volume completely. So let's go through each one. So you could buy some of it. Okay, let's say you buy some of it. Let's say your position size you're going to buy is, let's call it 5% position as is breaking out there. Well, maybe you buy 2.5%. So you buy 2.5 there. Now, at the end of the day, volume rate is minus 50, not plus 50, minus 50. What do you do with that? Do you turn around and blow those shares out? The 2.5, because it never got enough to get your second buy. Thought process is I'm going to buy half of it here and then buy the other half if the volume comes in, which is probably the best way to approach it, frankly. But with that, then your question becomes, what do you end up doing if you get hit? You buy the first half of your position, but the volume never confirms that day, but it confirms the next day, and it's 10% up. Now it's extended. What do you do? What do you do? Well, it's up to you. You're going to approach it but it's a problem, right? Now you're buying the thing way extended. Now, let's say the next day it's down. But you don't want to average down, right? So that would be problematic to average down. So what do you do? It turns into this huge quandary of dealing with that. Okay, so that's one issue. Now let's say the other approach is we're going to wait until that that volume is high enough to be 50% or whatever your threshold is, in this case, 50% or higher than the prior day. So what the average volume is, so let's say it's 100,000 shares, that for the volume rate to be 50% above that or more, it has to trade 150,000 shares on that day. So you could wait and say, okay, I'm going to wait until this stock has traded at least 150,000 shares on the day, and then I'm going to execute the order. But then that's this weird, like, luck, or you're either lucky or unlucky, and you want to try to eliminate that as much as possible. So that becomes problematic, right? And then also, if you're waiting for that to hit, it's going to be a different amount each time of what time of day that's going to hit. If you just think through it, like, what if that happens 1 minute before the close, or there's enough volume that it happens 1 minute into the trading day? So it's this randomness that you don't want. And again, like I was saying, is you've got to pretend like you are putting all of your money and your friends' money and your family's money into this black box, and you're trying to come up with this rule. Well, that didn't fly with me for that. So after a lot of studying and tons of back tests, I mean, this is what all I would do is I would just have a concept, run it, give it to my programmer. It would take hours and hours, because remember, this would go through uh, a back test all the way to 1963 every time I'd run this. I didn't do it on small sample size. Now, there were times where I would do it on half or a selected amount so I could do an out of sample study, but that's a whole different topic. But let's just say most of the time it was a full data set to get all the numbers. What did it do to the KGAR, the how much money you made, the drawdowns, the average drawdowns, your equity curve coming off the highs, how long did it take to um, you know, I think, what did I call it? Like the misery indicator or something, which was the amount of time until you hit a fresh high, and all these ways of looking at the results. And when I would do these tests, then I would look at, I would give him the new logic, he'd run it, then he would give me the results, and then I'd look through at the actual trades. And this is what I would do. And I'd wake up in the middle of the night and do this, because many times by the time that code would get done, it'd be 1 o'clock or whatever, and I'd go in and pull up the file and start doing it. Don't do that. Don't do that. I can do a health episode in a few weeks, and I'll discuss how that's what you don't want to do, but that is what I did. And so just for a few years, that's all I would be doing, is those, in addition to everything else, all those back tests. And I just kept running into this problem where I'd be missing these stocks historically because the volume wasn't there on the breakout, and it was just so problematic. And once you started thinking of the market mechanics of it, of like, when are you going to actually execute this trade, I realized that I couldn't use volume in there, because if you use volume, you don't know when to buy it. Now, there's this thing called a intraday volume rate, which was how we would adjust the volume throughout the day and prorate it. And so originally it was just on a linear basis. So there's 6.5 hours of trading, because we mark it up as 9:30 Eastern, it closes at 4 p.m. Eastern. And so what is that, 6.5 hours worth in there? So if you did it and just said, okay, well, you're 35 minutes into the trading day, then you divide it by that amount and just say, okay, prorated, that translates your volume into this amount at that time during the day. So just a prorated, you traded 10% of or 5% of the amount of time in the day, or 10% or 15% of the time for the day. And then so you take that 15% of your average volume, and then you say, where is your volume at that point? And then you come up with this kind of jury-rigged number that was never quite accurate, because in the first 10 minutes of trading, you'd have these huge numbers that would be like 1,000%, just the way the volume worked. Because if you ever looked at volume, it's like a U, where you get a ton of volume in the first part of the day, then it drifts off midday, and then comes back up really high later in the day. So the prorating of it, saying the volume is going to be equally spread out throughout the time of day, doesn't make any sense. And also, you can't just put this general U on there, because each stock would have its different U, meaning how much volume did it normally trade at the beginning of the day, middle of the day dry up, and then heavy volume at the end of the day. So ultimately, what we ended up doing is, because that bothered me so much, is we did a true volume rate. And that's what we've got in there now, where it's like, okay, it's 17 minutes into the trading today. For the last 50 days, what was trading at 17 minutes into the day, and then give a true volume rate. But that's not perfect, but it's the best that you can do. But there's still that natural tendency to have so much volume early in the day, but then it changes based on news. But it's the best way, and that's how we do it now in the products. And that was because it was really bothering me and anyone who really thought through it. So let's say you have that volume rate there. So you get an intraday volume rate, but your studies have been done historically on the end of the day volume rate. So now you're just making stuff up, right? Because you're thinking through logically making stuff up. If you say that your study said that a 200% volume rate was key on the end of your breakout day, and Bill said that you need at least 50%, which was also, it panned out with the volume. That would get you the vast majority of things, a volume rate of 50 would work. So he was always right. He was always right with his number when he would pick out a number out of nowhere. It was right. Like, it really was. I mean, I just call it the way I see it, good or bad or indifferent. But you don't know, because we don't have intraday data historically to test this out. What was the intraday volume like in 1963 and 64 and 65 and 66 and so on? And so if you're going to do this big back test and this algo that's based on this thing, but you don't have a way to test it, well, then it's just a theory. And you don't want to put hard-earned money out just on a theory. You want to actually go and study it. So that became a big quandary for me of like, what are you going to do? Because I was still believing volume was clean at that point. I mean, I had a little questions in my mind, but it wasn't full blown. So that became this, what kind of, the more that really bothered me, this dilemma I had for building the algo created my mind to start thinking about all these what ifs. Well, what if? Because remember, with the algo, I said, well, what if this thing happened that never happened? I had to plan for that. Because you got to remember when 9/11 happened and the market was closed for several days, what do you deal with that? Or when we would do our studies, historical studies, lots of times we end up with these weird things. Then we'd go back and go, oh, that was a one-off event. Like there was one, like President Eisenhower had this heart attack and it had this big impact on the market, but it was really short-lived. It was like this little blip down and then would go up. So there was all these anomalies that would happen. Or we had the flash crash that was a big deal. Just Google that if you weren't trading back then. So there's all these weird things that you have to plan for because you can't just say, well, I'm planning for it 99.99% of the time, because that's how you blow up. Remember, long-term capital. If you don't know about long-term capital, go back and search that and understand that. And that was my goal, was to not have a long-term capital debacle, because this was going to be a black box algo that was by definition not going to be touched. Like you couldn't go in there and say, oh no, the market's falling apart, I'm going to sell everything, or wow, the market's ripping and the computer for some reason is not buying it, I'm going to turn the dial, because that's not what a black box algo is supposed to be. It's supposed to do everything on its own. So that's what this mindset came from, is thinking through that you can't go back in time and cherry pick things or change rules when it suits your purpose for the data fit. You just have to look at reality. So that's where a lot of this came from, is just going through and saying, okay, well, what would you do if that volume wasn't there? Hopefully this is making sense to you, because I know it's a little convoluted and all over the place, but I'm really trying to cut off all these other tangents that I could easily go off on. So let's kind of summarize where we're at now. We're looking at the volume rate, and volume rate is on a daily basis how much it's above average. We're not even thinking about the weekly right now. We're just thinking about the daily, saying, okay, your volume rate on the daily has to be above this threshold, in this case, 50% above average. So more than normal volume is coming through there, but you don't know when that's going to happen. And then you have this other thing of you're trying to get the best possible price, but also the right price. And you're basing this off of what the price is doing. And so let's say that the stock is breaking out of 5150, but you're waiting for the volume rate to come in. But your other rule is you don't want to buy more than 5% extended. So it's getting close to there, but your volume rate isn't there yet. Now the stock is more than 5% extended, and now your volume comes in, and that's very normal. Now what do? You either buy the stock extended and take that extra risk on because you're waiting for this confirmation. Well, that confirmation better be enough to warrant the fact that now you're more likely to either, well, you're definitely going to make less than if you bought it at the pivot, but more importantly, which is fine with me, but more importantly, you're going to be in a position to get shaken out easier because your cost basis is going to be up higher, which is very important to me, which if you're trying to do something on an algo basis, you want to keep your enemy is any big losses. You can have a ton of tiny losses and a bunch of tiny gains, and you're banking on the fact that you're going to get a small, it's a really outsized gain. So if you think of it like a normal distribution, you're trying to cut off the tail end on the bad side so you don't have any really bad ones, which you can eliminate all of those because you're going to have gap downs. but you want to eliminate as much of those as possible and get it as close, the smallest loss possible, but you want to let this other tail work itself out, right? So it messes everything up if you're buying extended and then getting, shaken out where you shouldn't have. Because if you have a thing on there that you're not going to take more than a X% loss, well, if you're buying it really extended, it's more likely that that's going to happen. Now, if you were to say, I'm not going to cut my loss, I'm going to allow myself to buy extended. This is a valid workaround. I'm going to allow myself to buy extended, but I'm going to wait for the volume to come in there. But my stop loss is going to be the same as if it would have been if I bought it at the pivot. That's a workaround, because at least it solves one of the problems. Whereas if you were saying that I'm always going to have let's call it a 5% stop loss. Well, if you're buying something 10% extended, the likelihood of that triggering with a normal just back and fill type of reaction of the stock is much higher, right? But if you're using it based off the original pivot and you're saying something like, if maybe you've watched my episode on stopping your loss after the pivot, I forget what the name of it is or what number it is. In fact, I'm going to look it up. Okay, I found it. So it is episode 25, Webby's loss cutting strategy. So you can go watch that. But essentially, it's using the low of days, like the low of the pivot day, low of the day before. If you were to use that same one in there, then that would solve that one problem. But what would happen is you would have let's say instead of the 5% stop loss, you are going and saying it's got to go through the low of the breakout day and close below the low of the day, or just travel below the low of the breakout day for your stop. Well, that'll solve one of the problems, but it'll create a different problem. Now your average loss is going to get much bigger. And sometimes these stocks before the volume kicks in could be up 15-20%. So then now all of a sudden that distribution that we were talking about, and just if you don't understand a standard like normal distribution, it's just this bell curve where most things happen around the center, but then you have these edge cases that happen off to the side, and that just works. And if your data is normally distributed, that's how it'll work. And if it's not, then that's a whole different can of worms. But just assuming your data is normally distributed, if you're going to be opening up this one tail side, this is really going to probably hurt your returns, unless that waiting for that volume really makes that much of a difference. And you've got to decide, does it or not? And go and do the work and see why I decided not to, because that just gets way too big. So summarizing, if you are going to buy at the breakout and you are going to demand that the volume rate is there, then you're going to either miss a lot of breakouts, or you're going to be buying things really extended, even if the volume is accurate. Okay, even if volume is super clean, which is not, but even if it's super clean, you still have that huge problem, because whenever you're doing work, the more extra things that you put on there, the more things you're going to miss. So that's why, like, when I run my screens, lots of times I'll just have screens of, like, today, I'm recording this on Super Bowl Sunday, and I don't know when I'm going to release this. This prior week, there was huge volatility, like more than normal. And so when I was running my screen, some of them I just put in there, okay, this is volume over $75 million volume, period. Nothing else. Like, it could have anything else. And I look through all those stocks as well as all my other normal screens. Normally I put in there that some other parameters, like above their 50 and above their 200 day and above $10. But this time I just said, I just want to look at everything. And so, like, really casting a wide net, because anytime you put something on there, an extra parameter, like, so let's say I put on that it had to be above the 50 day, which is a normal thing that I do. Well, then I'm going to miss anything that's setting up in like a shakeout +3 that might have been coming in a base that was really deep, and it's coming up and it's just 1% under there. But then you could say, okay, well, why don't you put that it's within 1% of the 50-day. Fine. Well, what if it's 1.1%? Okay, then put it to 1.1. Well, now you're data fitting. So put it to 2. What if it's 2.2% away? So the more you put these on and really having to build this algo really changed the way I looked at everything, because I really did live and breathe that. And I would like to build another algo again from scratch, because so rewarding because you really have to mentally rewarding, because when you're done with it, you're like, wow, I really had to think through everything. And you have to think through this. What if this happens? What if this happens? Are we there yet? Type of thing. What if a stock breaks out on a Thursday on Christmas Eve, 10 minutes before the close? What are you going to do? Well, I know what my computer would have done. It would have bought it. So that's kind of an explanation of, even if you determine the volume is clean, let's just say you don't believe me on this. I don't care, man. I'm just putting this out there. I have no upside. What do I gain if I'm right? Well, if it's like anything else, like dollar volume, my changes on distribution, contributions to power trend, using the 21-day moving average, my quicksand Grateful Dead, creating composite rating, creating 3 and 6 month relative strength ratings, creating the original stock dog, blah, 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 all this at market school, the whole market school with the guys, inventing the IPO base, creating my cut loss strategy. What is it going to get me? Nothing. Other people are going to claim credit for it. Like there's no upside. I'm not going to get $1 for it. I'm not going to get any credit for it. And but if someone can poke holes in it, they'll love to do that. So there's no upside to this, but I'm leaving this for my grandkids. And I'm also just trying to. It was a fair question. I opened my mouth and told people that volume was dirty, and people legitimately had legitimate questions on why. And that's why I'm answering this. So most of those people aren't going to watch, because volume 1 came out yesterday and there's like no views on it. Like, so all these people who wanted to know, you clearly don't care. So I'm just leaving this. And the people who did watch, thank you. Thank you so much. In all the nice comments, thank you. But I'm just talking on the masses. So just documenting all this stuff. One day from now, like 20 years from now, if somehow I'm around, I'll just crack up when someone will tell me like, well, volume isn't clean. I would love that. I would just love to be around just for that. Anyway, so we've got through the daily. Now, what about the weekly thing? Okay, this is a huge problem. So Bill is saying that for that breakout to be valid, the volume rate has to be higher, or the volume, not volume rate, volume has to be higher than the prior week, as of the last trading day of the week. So breakout weeks volume has to be higher than the volume the week before. Well, if you're building an algo, what are you going to do? Just wait for that Friday to buy? Fine. You could build a strategy around weekly buys. Actually, it would probably be pretty darn good, because the weekly close is way more important than anything else throughout the week. So you could do what's called an MOC, or a market on close order, to buy at the close on Friday, and then you've got pretty much all of the information. In fact, with a lot of this, what I would have to do is do a market on close buy, just because at first you couldn't get through that was like the initial thought was, okay, we've got to at least do market on close buys, because you would need to have the sells and just the market mechanics of it that's a can of worms for anyone who's building an algo. Then you really got to get into those. It's not just like, can you buy that stock? Do you have the capital to buy that stock? Now, you might have the capital to buy the stock if you're not going off on margin. So you have margin to go from it, but then temporarily you might be more invested than you want to. And then your back tests are just all dirty data, because if intraday you're saying, okay, well, this stock is breaking out 5 minutes into the open, I'm going to go ahead and buy this, and then I'm going to sell this other thing on the close to pay for it. Well, you better hope that stock doesn't end up tanking that day, because then you're also going to have to sell something else too. So when you think through the what ifs, there's all these things where a market on close does make sense for all transactions, buys and sells. Also on a weekly basis, that would be very helpful because a weekly is more important than a daily, just like a daily is more important than intraday. But that's not what we're talking about. We're talking about a daily active algo is going through, and it can buy in the first minute on Monday or it can buy in the last minute on Friday. So if you have to wait until that Friday's volume to be complete before you decide what to do, and that volume has to be higher than the prior week, no excuses, no alibis, Mike, that how are you going to operate? Think about it. What are you going to do? Okay, so you're going to buy it all midweek. And then on Friday, if the volume isn't there, you're going to just blow out that order. That's one way. That doesn't make any sense. Or you're going to just wait until Friday and see if that volume is there. Well, then the stock might be 30% extended at that point. Does that make any sense? Unless that's just part of your strategy. Again, the weekly thing. That could be valid, but like you can't mix and match. So then you're going to be super extended. So now you're going to have other ways of controlling risk. And that's a whole different problem. But that's not how we trade. We don't trade weekly charts. We trade daily charts with weeklies, with monthlies, with intradays. So if you're going to buy midweek and not just on that Friday at the close, then that's the only way. You also want to buy it within X percent of your pivot. Let's call it 5%. Really, you want to much closer to the pivot as possible. Like the closer, the better, like to the penny. But that's another can of worms. So if you're going to wait for that weekly volume, then you can't do any of that stuff. Like try to figure that out, think through that. You want to be able to buy on Monday, but you don't know what's going to happen until Friday. So you can't build a back test around information you wouldn't have at the time. And that's why I always harp on this intellectual honesty, because I spent those years focused in on this. And you have to, if you're doing it right, you can data fit, like you can make the best looking. I saw people do this subconsciously, make these great back tests, but that's because they data fitted, like totally data fitted, like silly stuff. Like, okay, well, if the follow through days got to be above 1.87329%. Well, how do you come up with that silly freaking number? You data fitted, you like, give me a break, man. Like, yeah, I know you went to MIT, but Jesus, or Harvard or Yale or Princeton or wherever, but dude, they weren't passing out common sense. Data scientists, man. Anyways, so you've got to look at reality, right? And if you're in there, you've got to say, okay, well, what am I doing to my data set? Am I lopping off all these possible ones if I'm waiting for Friday's volume? Let's say Friday has higher volume than the prior week. Well, if that stock isn't extended, you don't want that stock by that Friday, right? Because if that thing isn't way out of there, there probably wasn't any true demand anyways. And so that thing is just going to roll over. It's a chicken and egg thing. So that's where I started thinking, well, just go off of price because that's clean. And then you don't have this extra variable. It would just be like if you were saying, well, the earnings had to be a certain way. Well, if the earnings had to be a certain way, and then you're looking at it, you're saying, okay, well, what if the earnings came out on that day that thing happened? Do you have that information at that point? What is the exact timestamp that information came out? And you got to remember, historically, earnings used to come out throughout the day. It is more in the normal time, in the more recent years and decades, that is gone to this pre-market and post-market, but it used to be out throughout the day. Earnings would just flow through, some pre-market, some post, but most would be just continuous throughout the trading day. Then you've got to say, okay, well, if I'm going to do a back test, I need to know exactly when those earnings came out, because what if the earnings came out at 10:30, but it went through its pivot at 10:29? Well, then you're mixing, like, how can you trust your back test? Or if you say, okay, it happened on that day because that's the information you have, and then you just do some assumptions in there. Well, then you're really playing with fire because those are going to be your edge cases that you're going to miss. So if you're waiting for fundamental data, you better have a full data set with the exact timestamp of not only was that information released, but you have to have a buffer in there for when you could process that information. So, for example, when I was in the research department in 97 through 99, that's what our task was. One of our primary tasks was earnings would come out off of this in this room that was called the wire room. And it was this big continuous roll of paper. And then the wire monitors would say, okay, well, IBM's reporting. And then they would tear it off. Then they would bring it over to you, put it on your desk, and you would have to read through that prior to AI. You have to read through that, take any of any charges and extraordinary gains, losses, what have you, back those out, read the footnotes, see what you can back out, and then put the clean number in the database. And then once that clean number was in there, then if it met a certain profile, we would actually fax those to Bill at his house. I mean, that was a big deal. They were called hot stocks. And so it was basically if there was acceleration in sales or earnings or both, they would get faxed over to him immediately. But even with us doing those quickly, you had this lag in time from the time that the press release came out to the time that it was actually, you could physically read it, update that information, put it in, and give it over to the person who is fax it. Like you have this time element in there. So in some of them, you could do that earnings, put that in there in 5 minutes. But other ones, it would almost take you an entire day. I think it was like GE or Boeing or somebody had this big complicated thing. It was like a book, you just would dread getting that one because it would literally take you an entire day to back out all the charges and come up with these if you're going to test this, then the fundamentals, then you have to have that timestamp. It's very important. Otherwise, you're fooling yourself into just thinking, oh, you can figure it out based on what the stock did on the chart when those earnings came in. You don't know. And you don't know what it did in 1974 or 83 or 97 or 2003 or what have you. So you can't test it. Then it just becomes a theory. Well, what is that? So with the fundamental stuff, you can't go down that path. So we have the problem with the fundamental information because you don't know what that is if you're looking at the most recent quarter. Now you can do historical stuff that you would have already had, like annual information or sales historically. But if anything includes what the most recent report, if it's going to change it in any way that would keep you from buying or selling that stock with any news that would come out that day, then you've got to rethink that. And you can't use that in there without knowing the timestamp. And so that becomes very, very important if you care about reality. So fundamentals are off the table for this black box, and the volume we've found is off the table. So you just go off of your price. And so that was long before I even thought that volume was dirty. Hopefully that part made sense. And that was a lot longer than I had planned on that particular topic. So we will switch topics to one last one. There's so many other things I had planned on talking about today that we just don't have time to do. So we'll just do one other one, and this will be a consolidated volume. So switching gears. So we were talking about individual stocks. Now we're going to be talking about consolidated volume, or let's just call it volume on the NASDAQ or the New York. So consolidated volume. So let's call it NASDAQ, NYSE volume, like either one. Let's just simplify it and just say the way Bill would approach things is when it came to a distribution day or follow through day, that those are very important concepts of how we look at things. And I think I probably had some episodes on that. Hold on a second. Right. I had to look that up. No, I don't have my episodes memorized. So it looks like episode 10 was on follow through days. And then also episode 13 was on follow through days. I'm not sure if I did more. That's probably all I did on those. So I'd go and watch those. But follow through day is a way that we go from basically being negative on the market to positive on the market, and distribution or bad days that you get a bunch of them, and they mean it's a whole different topic. And I have a whole different way of looking at distribution than how we used to. I mean, in fact, I mean, just to tell you one more thing that I changed that no one even knows about was distribution. So distribution was originally volume higher than the prior day. So when distribution and follow throughs, it's never about volume versus average. Everyone gets that wrong. Everyone gets that wrong. Volume versus a prior day. Average volume does not matter. Period. Exclamation point. So volume versus a prior day, and you would want it to be higher to signal that it's a follow through day, assuming that the price action matches it. And then on distribution, it was just that it was down on the day and volume was higher than the prior day. So the distribution has always bothered me, the way we looked at it. And so I built this thing, or had this thing built in Wanda, where I would test out different amounts, because I just said down, like it just didn't make sense to me that all these things would happen, because Bill would say, okay, 5 days of distribution within our window of time of 25 days, and then boom, you have to be out of the market. That's what he would do. He'd go 1, 2, 3, 4, 5. Boom, got to be out of the market. Now, other times it'd be like 8 days of distribution. You'd be like, well, it's different this time. Like that's where the whole power trend thing came from, to try to deal with that. But he was hard and fast at times with this distribution. So it was a really big deal, what we called a distribution day. And then churning and stalling, that's a whole different topic. But just being down on the day really, really bothered me, because there were some days that it was just down like point whatever, just a tiny bit. And I was, but it just doesn't feel like distribution to me. So I did this study where I tested out all these different time frames. And at the time, he would say 3 to 4 to 5 weeks. He would just pick these random times. I'd be like, well, is it 3? Is it 4? Is it 5? And what happened? And he would go, well, it depends. And well, like depends doesn't, like, if you haven't picked up on my psychological issues are like black and white and whatever, some psychologists are probably watching and going, well, he is OCD, or he's Asperger's, or he's just freaking crazy, or he's whatever. Like, it is what it is. I don't care, man. It's like, you're wired the way you are. Like, you don't control that, I don't think. But so when I look at something, I'm like, okay, well, it's either right or wrong. I'm still searching for my touch of gray, but can't always get everything you want. Anyways, mixing too many things up. 2 people get my jokes. If you ever wondered, yes, I do put a lot of musical references in here to keep myself interested. And if you ever say, was he referencing a song? Yes, I probably was. So we're looking at this and saying, okay, if we get enough of these, and I'm not going to get into that whole thing of the tangent of how we ended up with the 25 days, but well, that came from me because I was really bothered by it. Well, I'll just get into it because otherwise I'll forget. That he would say 3 to 4, and then he would say 4 to 5 weeks. And then I'd say, okay, well, if it's on a Monday, are we looking back? Let's say it's 4 weeks. Are we looking back 4 weeks? Well, on Monday, that's going to be different number of days than Tuesday. And then on Wednesday, that's going to be a different number of days than Tuesday and Monday. And then if you're looking back weeks in addition to your current week, and I'd ask him this, and he'd go, well, it just depends. And that didn't fly again. So we ultimately went with 25 days because it was just this rolling time frame, and we could have done a different time frame, and I don't think there was anything magical, but it had to be where it was you're moving in time the same amount. So I tested out 15 days and 20 days and 25 days, but with different levels of just being down on the day, or being down 0.05%, being down 0.1, 0.15, 2, 2.5, 3, and so on. I was trying all these different things, and I had it built into Wanda where it would show me a line of how many distribution days during that time frame, and I would test out all those different ones. And ultimately, Bill kind of pushed me into like picking one of those, and the best one was a 0.2. It was a lot harder than that. So we had to go with the 0.2. Was 0.2 perfect? No, but was it better than 0.00? Yes. And so that's how that whole thing came about, if you ever wondered, because Yeah, like most things, my name isn't attached to it, nor do I own it, like everything. But, whatever. What are you gonna do? Can't change back the clock. If I get a DeLorean and go 88 miles an hour, who knows? Maybe I'll get one of those one of these days. Always love those. If you don't know what I'm talking about, go and watch Back to the Future 1, 2, and 3. Like, if you haven't watched those, what's wrong with you? Geez, especially 1 with the whole scene with, man, Michael J. Fox, man, my heart goes out to him. God, he was one of my first people that I wanted to be. Like, if you go back to his the show, was it Family Ties? Or I always get that one mixed up with another one, but when his character, Michael P. Keaton or whatever it was, like, no, what I'm mixing things up. But anyways, that there was this one episode that he had where it was one of my favorite episodes because he was like so into money, and then someone dropped like some random change or something like that. And then he was able to pick up like, oh, well, you drop a quarter and a nickel and 2 dimes or something like that. And so I tried that out for a while to try to, because I was a dork. But man, and then he came out with Back to the Future, and man, what a just a lovable guy, and I just wish him the very best. And I saw him recently on an episode of Shrinking, which is on Apple TV, which you should all watch. And I am going to talk about that show on my health episode, and that you'll see why. But the new series is out. It's just such a great, great, great show. Not for kids, not for kids, so adults. But anyways, I don't even know where I was going with that. What were we talking about? Oh, the different the distribution and all. So with the distribution, we go with a set amount of days, and it's the point two. I'm sure I was lost my train of thought, but as I said, I'm maxed out these days. I've got way, 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 way too much on my plate, man. Way too much, way too much. I mean, I just can't handle it. I really can't. But you got to do what you got to do, man. There's no crying in baseball. There's crying on Webby Rambles On, but there's no crying in baseball. And you gotta. There's no giving up. You gotta finish what you started. So we're looking at We're talking about volume. Yeah, that's what we're talking about, Mike. So we're looking at distribution volume has got to be higher than the prior day, and it's got to be down 0.2 or more. And follow through days, the volume just has to be higher than the prior day. Does not have to be above average. And then there's the price element on there, and that's watch that to see. But let's just call it. It's got to be up 1% on day 4 or after of an attempted rally. And so you would have your volume has to be higher than your prior day. So what Bill and I would do when we're in there looking for a follow through day is I have this other thing built for us in Wanda. And Wanda is just like Market Surge, but was a version that we used. And so I was director of research and development for a while there, and senior VP over there. And so I was able to get a bunch of my ideas and stuff put in there. And one of them was lots of them were just things that we would just use internally. And this was this thing that would see what was the volume compared to the prior day, because that was everything for us. So at first, when we didn't have the ability to do it on a minute basis the way we do now, it was just it was the first half an hour, and then it was every hour it would check. So it would look and see, okay, what was the volume running at 10 o'clock Eastern yesterday? So a half an hour into the market, okay, it was this much. Now at 10 o'clock today, was that volume higher or not? If it was, then it was on track for a follow through day. If not, it wasn't. And then we would have I had the percent in there. And you could get to this by hitting the F12 key. So we would always just say, what is the F12 show? And so Bill would call me up, Mark, what's F12? And he could have pressed F12 on his key, but he would call me all the time just because then he would want to talk about the market or whatever. But that was his way of breaking the ice. He could have hit F12, especially when he's saying, what's the F12? And so we would be watching that like a hawk on follow through days, because if the volume was running higher than the prior day early on, we would assume that it would be running higher later on in the day. But then we would also look and see, okay, was there a news catalyst midday on the prior day? And if so, let's say there was some news came out at 12 o'clock Eastern, we would then have to wait until we got through that hurdle. So we were comparing apples with apples. But anyways, we will watch that like a hawk, and then we would never know for sure until after the close when the full completed volume would come in, but we would be operating off of this intraday thing. And that became a big deal because that's how we would make market calls. Like we're either still in a bear market or intermediate correction or not, because once we get a follow through day, he would say you're back in an uptrend, period, until proven otherwise. And that was his mindset. Just like he would say many times, you 5 days of distribution, even if you're 1% off the highs, you're in a downtrend, period. End of story. You're not allowed to buy. You're in, other times it was different. Again, that's why we came up with um, the market school rules, and there's a home study involved with that and all that. I'm not trying to sell it. I don't get paid a dime for that intellectual property that I created as well, along with Chuck and Justin. But if you're interested, definitely get it. I stand behind that. We need to go in and change a bunch of this stuff, but it's still something I use every day. Is it perfect? No. Are there lots of things that need to be adjusted? Definitely, including dropping all volume. That's a project for another day, another year, not this year. So now we're looking for a follow through day. We're looking at the volume versus the prior day's volume and saying, okay, is it running higher or not? If it's running, let's say 5-10% higher than the prior day, that's enough to allow for things to taper off later in the day. If it's right at even or maybe plus or minus 1 or 2% versus the same time of the prior day, then you have to operate differently and you have to wait until later in the day. So this was a big deal that both of us would look at, and it became important too on key distribution days. The distribution count was really high. We'd be looking at this Mach, let's say F12. So that's distribution and follow through and how you look at the volume higher than the prior day, and how you would look at it throughout the day, intraday versus the prior day. That's how just we would look at it. And it was, again, no excuses, no alibis. If the volume wasn't higher than the prior day, we wouldn't call it. Okay, just so you understand why the consolidated tape, that's what we call consolidated, by just you add up all the stocks either in the NYSE or in the NASDAQ, and then you tally up that volume, and then in shares versus the prior day in shares. So historically, that worked really well going back in time. And well, there was one where, yeah, that's a tangent. Remind me sometime in the 1950s, but we won't get into that. That's a whole different topic, but not a whole different topic, but not as important for that. It's more price oriented. So we would look at this for follow through days and be really like, if the volume wasn't higher, it could be the same as the prior day, but it had to be the same or higher. Because back in the day, volume was so low that sometimes you be the exact same. These days it would be like, with the numbers we're dealing with, it'd be so weird for it to be the exact same. It'd either be slightly higher or slightly lower. But just telling you the way it was back in the day. So the same or higher than the prior day. We went into the whole intraday thing. But now think through, okay, volume was clean, and then volume started getting dirtier. Well, one of the reasons why volume got dirtier, we talked about the whole option thing in the last episode, and we talked about the Reg FD in the last episode, but there's another thing, and this is splits. So if you don't understand what a split is, so with a stock split, it is meaningless, right? So let's just say I was trying to look for, a $20 bill and then 2 10s or 4 5s, and just wanted to show that as an illustration, but I just didn't have that handy. So you've got, let's say you've got a $20 bill. That's your normal stock. Now it does a 2-for-1 split. So now what do you have? You have 2 pieces of paper with the same value. Now you have 2 $10 bills, both still worth $20. Oh, let's say it does a 4-for-1 split. Well, instead of the $20 bill, now you have 4 $5 bills. Nothing else has changed. But back in the day, what would happen is stocks would like to keep their prices low. Like once it started getting materially above $100, as a general rule, stocks would split, because going back in the day, these are important tangents. So an odd lot is anything other than 100 share increments, right? So 99 shares, 1 share, anything in between, that's an odd lot. And for odd lots, back when you had to pay for commissions, you had to pay a lot more for that odd lot because they knew they had you because you couldn't afford the full 100. So you had to pay this extra. So it became even more expensive. So it became more meaningful. And there used to be this thing called the short sell odd lot thing, which was a reverse indicator, or it was a psychological indicator that would say, okay, if you got a lot of people that are shorting, and they're shorting with odd lots, it means it's the small guys and girls are in there, and they're probably not that smart. That was the old thought process. So if you get a lot of these people shorting, then the market is probably turning because it's obvious to short when you're in a big correction or a prolonged bear market. Then people think, oh, the only way to make money is shorting. And so everyone and their brother starts shorting, and that's when everything turns and goes the opposite way. I don't use that at all, but that was back in the day and fairly good. But it just doesn't make sense anymore because now the key ingredient there is commissions being higher for that. So people really care. Well, that's not the only reason, but there's others. Don't go on tangents if you don't have to, Mike. I'm talking to myself. Did I say that out loud? Okay. So now we've got, God, there's so many things I'm trying to not tackle, but there are important things here. So we're looking at the consolidated tape. We're looking for follow through days, and we're looking at I'm just trying to think what I can cut. Okay, I just had to think for a little bit. I'm back because I was like, man, there's so many important tangents that are important, but let's just tackle these key ones. So we're talking about odd lots and commissions and on. We're talking about the consolidated tape. Okay, had to put some thought into how to simplify this as much as possible because there are a million tangents that are important to go on, but we're just going to do some key ones now and maybe the rest in future episodes. So we're talking about the whole odd lot thing. So with odd lots, there was this desire for companies to split so that the average player could go in and buy a full round lot. A round lot would be 100 shares. So took substantially less money to buy a $10 stock than a $100 stock if you're going to buy 100 shares of it, right? So once the stock would start getting up in price, the company would split their shares. Again, you had a $100 bill. Now you've got 250s, or you've got 10 10s, or you've got 420s. The same value, but they split the price, and it's lower. And psychologically, this was so important that back in the day, there was actually services out there that would alert you the moment a split was announced, and people would pay for that. And rightfully so, because it did have an impact on the stocks. The stocks would just go up on the split. The other thought process is that people would look at is, okay, a company doesn't want to split if they're going to be rolling over. If they think they're going to be rolling over, they want to split if they're going to be continuing to go up, because they don't want to have that egg on their face of, like, let's say it goes up to $100 and they split it 2 for 1. Now it's $50 and then it starts rolling down. Now it's $20 or $30 stock or something. They don't want that. So the thought was, okay, the company is only going to split if it thinks everything is doing well. But then you had some people who didn't want to split. So like Berkshire Hathaway, Warren Buffett's company, was the classic one that it did not want to split. In fact, the Berkshire A, BRKA, let's see what the price is right now. It's hard without commas in that. $762,569 is what it's at currently. So that's kind of high, just a little bit high. So he was one of the few who didn't split. Most people would split. So then what would happen is your average price that you would get of all the stocks in the database were closer together, because you would have this kind of this area where the companies would tend to like not go higher than that. It'd be like $200 or something, and then they would definitely split, or some I can't even remember what the key number would be, but really 100, $200, something like that. And they would split. So this is important because your consolidated share volume for that index, either NASDAQ or NYSE. NYSE is what we would use for Dow or the S&P because we like to mix and match apples with oranges, which is as silly as can be, but decision was made before me and without me. And then NASDAQ was for all the NASDAQ stocks. So at least that one was clean. And so you would look at that, and all of the stocks were pretty much in the same range. It would be from 1 penny up to, let's say, the bulk of the data would be from 1 penny up to, let's say, 100 or $200, and you have a few outliers out there. So the volume was more evenly distributed than it is now. So after a while came this kind of thing to stop splitting, and I'm not sure which stock did it first who didn't want to split, but you had, several of them that didn't split, and there were these big names, and all of a sudden you'd be trading $200 and $300 stocks or $400 stocks or $1,000 stocks or more, and became much more normal because the splitting thing just kind of went away. And I guess it was probably at the time where commissions became um, cheaper and free, that there wasn't this desire. Now there's a separate desire from like an option standpoint because the options are still done in those round lots. So that's pretty much the only reason why people really want to split these days, because then it allows people to do things easier if it's lower price because of that. With the whole options, without that is one of the tangents I didn't want to get off onto, so I'm going to leave that alone. But just realize the option is another reason why they would still want to split. But that changed. So now if you looked at the distribution of the price data in the database, it was all over the place, from the penny stocks over to thousands. And it wasn't this thing where most of them were under 100 or $200 with some outliers. It was really starting to get spread out. And these ones that were really important, big ones, those are the ones that, because you don't get a junky stock that runs up to be $1,000 or $500 or something. It was more the quality stocks. In fact, Bill at one point had this theory that the best stocks were the highest priced stocks. And he actually had us on one of the prior episodes on my Any Given Sunday with Bill, that episode that I just recently did. I would watch that and talk about these custom books that both of us got. And for a while, he was doing this thing with just the highest price. He just wanted me to put in there the highest price, like 100 highest price stocks. And he just thought that was key. And you know what? It was a pretty good list, gotta say, because at that snapshot in time, people weren't splitting. And those were kind of your quality stocks, your CMGs of the world and your NVRs and think price lines, and I'm trying to remember all the ones that were super high priced. But anyway, the 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 data started changing. So that changed what the consolidated volume was. Because think about it, if you've got, let's say, Amazon is trading $5,000 a share, right, versus a 10-for-1 split, and is trading reasonable, or I don't want to give into specific stocks, but this one stock is trading at $500 a share. So now it does a 5-for-1 split. So now it's trading $100 a share, but you're still looking at share volume. Well, now you're trading one that has changed dramatically. So the same number of shares, say you're looking at the market averages on Thursday, and the stock hasn't split yet. Now on Friday, it has split. So now you're dealing with a difference there on that one day. So one day, no big deal, because you don't get splits all that often. So that's just a little thing. Doesn't really bother me that much. But collectively, your important stocks that when they weren't splitting, those are the ones that really made a difference. Like it was a real demand for Amazon and Apple and CMG and whoever. Was that that's really what would make a follow-through day or a distribution day of the key stocks. And so the key stocks were higher priced. So therefore, the same dollar amount. So let's say you're a portfolio manager and you're going to move $100 million of your portfolio around today. Well, that's not going to be equal equally distributed in share amounts to all the stocks, because some stocks you're going to be doing stuff with are going to be $11, other ones are going to be $110, other ones are going to be $1,000, and so on. So the amount of shares that you're buying or selling with the same dollar amount is going to vary dramatically. So that is going to change what that consolidated tape is, the total share volume on the day. And probably the best examples would be when you see those key days where the little thin little goodies, as Bill would call them, had, or low price pieces of junk, as I would call them, were had this big spike up in volume, like a billion shares, like of a 10-cent stock or something. Back in the day, you would never have that, because with commissions being expensive, the way we talked about in the last episode, and spreads being wide, you would never have all that activity in those low price stocks. But now, with having penny or even less spreads on these thin little stocks with no commission costs, you get people in there, they're not truly buying, they're just day trading it. That's not buying pressure or selling pressure. That is just people in there for the day, and they're going to be flat on that position by the end of the day. And you will see these huge, and I know that for a fact because you'll see the total number of shares outstanding. Let's say it has 100 million shares outstanding, but it's traded 500 million shares on the day. That means every share has traded hands 5 times. Well, obviously some of them never sold, like insiders and stuff never sold. So your true floating shares, which is a whole separate topic, maybe we'll talk about in a future episode, but those are the shares that are not held by insiders. So the shares that are, you might have 100 shares outstanding, 100 million shares outstanding, but the float might only be 20 million, meaning that other 80 million were owned by insiders or people who were private equity early on, and so they're not selling their shares, they're holding them for the long term. So the shares that are freely traded are that 20 million, your floating shares. And so let's say you trade 20 times your float on the day. That can easily happen with these thin little things or pieces of junks. And that will distort the volume not only on that day, but for the next day. So let's say on Thursday, you're not looking for the follow through, but that is the day that you have all this activity because there's some news item on some biotech that's 10 cents and it goes up to $1 and it trades 1 billion shares. Go through. Like, this stuff happens all the time. This is not some like, oh, what if thing. This stuff happens all the time. So you're looking at that and it's traded that many shares that day, and you're like, well, that wasn't real buying or selling. Do I just back that out? Or what do I do with that? What is the right answer there? Do I just put it down to average? But it really happened. So those were shares that were traded there that weren't traded in something else. So you can't say that that money didn't truly change hands because that money was tied up in there. Like, it did happen. So you don't want to back that out because it wasn't like not reality. But then the next day, that news isn't there on that stock. And that's when you have your follow through day. And so now your volume, your share volume is less because you have this 1 or 2 outliers that really had a material impact on the share volume. This happens all the time. Trust me, all the time, all the time. You notice it when there's a big news item and it's a big story thing, but just look at the share volume any given day and do that for a month, and you'll see these anomalies that happen all the time. And then, so now you're looking at share volume and saying, well, I can't really trust share volume because you're treating 100 shares or 1 million shares in a 5-cent stock the same way as 1 million shares in $1,000 stock. That makes no sense on any level. Try to explain that to me like I'm a 2-year-old and it makes sense. You can't. You can't. There are some things you can't do. You can't do that because it's different, right? It's materially different. 5 cents trading 1 million shares or $1,000 stock trading 1 million shares. How much money does it take you? Just do the math, break out your calculator and say, how are those the same? They're not the same, but on the tape, it's the same. And on that consolidated wrap up of all the shares that you are deciding whether the market's in a confirmed uptrend or not, or the market's rolling over or not, because you're saying that the volume has to be higher than the prior day for this key event to happen, a follow through day or another distribution day. So that's a big time problem. Okay, solution. There's a solution for that. Use dollar volume. That's an idea I came up with a decade or so ago. Now other people are like forgotten where that idea came from, like everything else. That's fine. Dollar volume is your solution that's saying how many dollars actually moved through on the exchange. So you take your share price on the thin little goodie, multiplied by the shares that were traded, and then tally that up. So you do your dollar volume. So one of the problems with dollar volume right now is there's not a real-time data feed on it. You can get it. Like I used to go to like NASDAQ trader.com or something like that, and I would look at the dollar volume, but it would be delayed, and there were all these different tapes, like tape A, B, and C, or all this stuff that I've forgotten about. When I looked into it, it just made it even more noisy. But the dollar volume, historically, you could recreate it, but then you have to really trust that you've recreated that properly to study that dollar volume. But back in the day, you didn't need it to be dollar volume because share volume was fine because it was clean. So then you'd be comparing clean data using dollar volume versus share volume when you really didn't need to now where share volume is just completely irrelevant on a consolidated tape. It's just funny that anyone even looks at it. I mean, it's the silliest thing. Dollar volume, not silly, but just problematic, because if the underlying volume is dirty, adding that up doesn't make it any cleaner. And we talked about in the last episode how the volume is dirty, and we will continue on in this episode of more reasons why it's dirty. It's not one thing, it's all these things collectively adding up. So the splits and lack of splits, and then splits again, are one of the problems. The other big culprit, like I talked about last time, it is the cost of buying and selling. I mean, if you ask me one thing that has changed that really gets it to be different now and why volume is dirty is there's no true cost to trade, because, and we'll get into this more in future episodes, but and we touched on it or got into it a lot in the last episode, but just think about it. A high frequency trader, a computer that is just in there, just going in between the bid and the ask. We talked a lot about the bid and the ask last time. What you get for it if you sell it is the bid, and what you pay for it if you buy it at the market is the ask. So the difference is your cost. So you add that cost plus the commission cost plus any slippage. And slippage is if you're trying to buy in any size, any large amounts other than 100 shares, how much are you really going to end up pushing that stock or not pushing that stock? So the more liquid the stock is, the less you're going to push it. The more illiquid it is, the more you're going to push it. So that cost has gone from this big to like nothing now. Like you can go in and buy it, and then in some cases just turn around and sell it, and it's like less than a penny a share difference, or let's just call it a penny. And so that's nothing compared to before. It was like big money, big money. When you look at the spreads being wide, like prior to decimalization and prior to commissions being free, like we're and without all these computers going in there, because you actually had people that were in there. Like think about it now. You go try this not for fun, but next time you're going to put an order and it's not time sensitive, you need to get done. Put an order in between. Well, no, don't do this. Watch someone do this, because I don't want to I'm not an investment advisor. I can't give investment advice. So don't do this. Just in theory, let's just say I do this. And I have done this many times. So you get a big spread and you want to see, is there an algo in there who's buying it or not? So you watch it and you go, okay, let's say it's 51.25 by 51.50, meaning bidding 51.25 and offering 51.50. So if I want to go in there and buy some and I want to see what's going on there, 51.25 is, if I go in at 51.25, I'm just riding along with the other people at 51.25. So if I go in and put in 51.26 and immediately that bid goes to 51.27, right? So it was originally 25 cents quarter. I go up a penny. inside, right? So that means that if anyone wants to sell at the market, it's going to hit me. And instantaneously, like the second that my thing gets changed to 26, it goes to 27. And then I go, okay, well, I'm going to go to 28. And then it immediately goes to 29. Well, what's going on? Is there a person there that's that fast, that's able to change it? No, it's a freaking computer. It's a computer going in there. How is that true buying demand? It's a computer going in there saying that either its algo is to be the inside bid, or it's going and saying, okay, if someone wants to go on the inside of the bid and wants to close that spread, well, there's a real buyer there, so I'm going to go in front of it. They might not have even been there originally, or it could be just their instruction is to sit on the inside bid and just sit there, right? And that's not how you want to do things. I mean, I'll tell you this order that just killed me. I'll never forget it. It was February, I think it was February of 2000. And I put an order in, and the stock was Epiphany. And I put the order in, and it ran up. I hope I remember this right. It's like 14 or 15 points before I got filled just on the 1,000 shares. And I called the desk, and they were going and sitting on the inside bid. And because that's how, remember, our trading desk was also traded for big institutions, and big institutions are very price sensitive, and they don't want you running up the price. They don't want you taking the asset. They want you sitting on the bid, getting better prices, because they're buying hundreds of thousands of millions of shares, and collectively they would rather just sit on the bid. But if you're smaller and you're more time sensitive, that you want to get done when you put that order in. So I put in my 1,000 shares to buy, and I still remember, I'm like, okay, 5,000 Epiphany market, always market, but it was adamant market. So then it starts running. I'm like, oh boy, I need more. And so I go, buy another 1,000. And the girl is like, well, Mike, nothing's been done. This thing is ripping. You want me to just buy up? I'm like, yeah, you were supposed to buy it 14 points or 10 points ago or 7 points ago. Yeah. She's like, if I go on the inside bid up here, they just keep on jumping in front of me. I'm like, well, don't sit on the bid. Just take the freaking offer. I might have used different language. Just take the offer, meaning whatever. It's like, if I take that, the offer is going to go away. Yeah, just frickin' take it. Anyways, we went round and round on this, and finally the person comes back with like 14 points up, if I'm remembering right. It might have been more, and then you're done without an I'm sorry or I screwed up or whatever. And I always remember that the market mechanics of a bad trader who doesn't understand what they're doing. I'm just being frank, who didn't realize that this was, a month before the market top and the Nasdaq, and things were lifting like that. There's a time and place where you want to sit on the bid. That was not the time nor the place for it, but the stock that's breaking out, and they would see, oh, okay, well, 1,000 on the bid. Well, shoot, just show 100, 900 of it. How would I have done that order? Would have put 100 shares on the current bid, whatever the current bid was. It wouldn't go on the inside bid. I'd snatch 300 from the offer to see what happens there, and then adjust from there, get something done. Okay, well, I take 300 shares at the offer, but really there was only 100 there, and then it moves away, and then I have to reach up to get another 2. Okay, so I know there's not a true seller there. So now I'm going to go on the inside bid by up a fair amount, because I don't want people to jump in front of me. So then I'm, instead of going up a penny, maybe I go up 15 cents. So someone maybe hits me, but at the same time I go up and I grab some more from the offer and try to work the order that way. But that's not how the order was done. It was, I'm going to just sit on the bid and let things hit me. Well, no one's going to, when there's a buyer in there, no one's going to sit and go, okay, I'll sell to you as the thing is lifting. Give me a freaking break, man. Same thing happened on the way out. So by watching these orders, and I would get so much of a feel, because I'd put my order in and I'd sit and watch time and sales in the level 2, so I would understand. And that was the poker game, and that's why I used to use volume so much, because you could get so much information from that. So think about it this way: if you put an order in for 1,000 shares, it was a hot stock, and that stock was in position, and you got filled, and you got maybe better than the offer. So let's say the offer was 51.50, and you go in there and buy whatever it was, and you get 51.49. Dude, you should just sit or turn around and just sell that stock right then. Again, not investment advice. I'm talking back in yesteryear, because that meant that there was someone really wanted to get out of that. There was a big seller there. And so that stock is going to go down, man. You want out of that. So you always wanted bad prices, but you didn't want horrible, you didn't want 14% higher without an apology. So that was 26 years ago, and I still remember it like it was yesterday. And it still hurts me to this day because, man, what are you going to do? You add those up over a long period of time, and why I started really paying attention, and I started putting my orders in with algos instead of having people work it for reasons like that. But that was a really bad example of that. But so circling back to, I know we got off on the tangent, but maybe by explaining that, you kind of understand the market mechanics, and you do that over the broad market, right? And you add that up, and you realize that now you can get that same thing done by just a computer going in there and working it, and where there isn't a person sitting there. And so a person has mistakes that they make, right? And logic mistakes, just fat finger mistakes, and everything in between, whereas a computer really doesn't. It has to be a bug in the logic, which means that whoever programmed it made a mistake. But if it's bug free, as much as anything can be bug free, then it can execute those with really tight spreads. And so if you've got a tight spread and you don't really have that cost of, I'm going to buy 1,000 shares, it might run up $14 on me. I could buy the 1,000 shares, and if I don't like it, I can turn around and sell it without any true cost. That's when you get a whole lot of buying and selling in there that isn't true buying and selling demand. I mean, hopefully this is starting to make sense to you, that you get all this activity that is going just because that's a hot stock for the day, and these people are going to be out of this and flat that position by the close. That's not buying demand. That's not selling demand. That is seeing that there's this active stock, and now with the market mechanics, you can go in and do a whole bunch. And so, yeah, that volume rate is going to be up, but it's not truly the way it used to be, where someone going in and truly wanting those shares, because what if they turned around and decided to sell it? They're going to take a 3 or 4% loss on that, versus now like penny loss or two pennies or something like that. So you add that up on the consolidated tape, and that is very problematic. So using, even from a dollar standpoint, so share volume week is just, if you've thought through that, like it's just just worthless. It's a joke. Dollar volume better, but still when you add that onto it, it's just not telling you what you need to know. It's telling you what you want to know. And I see so many people say, well, I had some questions go, well, if XYZ stock broke out, this was I forget what, there were two stocks. They were like, well, if volume doesn't matter, then explain this, Mike. Why did XYZ stock break out and fail, and it had no volume on the breakout, but this other stock broke out and it had volume and it worked? Dude, grow a freaking brain, man. Think through it. You got a sample size of 2 to start off with, which is as freaking the silliest thing as can be. But let's just take it as you just mean this in general. Well, then look at everything. Look at everything. And if you think that the volume rate now is the only deciding factor on a breakout, study it now. See how that works out for you. Do it. Just do the work. Just do the work and look at it and see and go through what I was saying before is, okay, let's just say it matters, and you can prove that volume rate matters. Now go into that exercise that I was saying, well, what would the volume rate be that you would know at the time it was going through the price that you wanted, and go through that dilemma that we talked about. So knowing that the volume rate at the close is one thing, but what at 9:31, 1 minute into the open, what is that going to be when it's going through the price that you want? So keep it freaking simple, silly, and just look at the price. This is a hard enough gig as it is without making it more complicated, but people like to feel comforted. They want to feel comforted. I want to feel comforted too. I want Led Zeppelin to have a reunion tour at the Sphere. That would make me very comfortable, very happy. I'd try to be there every day that I possibly could be, but I don't think that's in the cards. Just like I don't think finding out how dirty volume is is in the cards. It's dirty. How much? We don't know. If we could figure out that it was 5 or 10% dirty, if I could figure that out, I'd still use it. But I don't know. But I think it's different at different times, and so that's it's changing. So on a given normal day, without any risk events, meaning big earnings, big tweets from DC, big news out of the global key players, without the Fed, it's not a holiday week, and just a normal run of the mill day and a normal run of the mill stock, volume's probably accurate. But what if it's not? Then you have to, or relatively accurate, or I don't even want to say that. But there are times where it's dirtier than others, but you never know exactly how dirty it is. We will talk about on the next episode, we'll talk about where I do think volume is clean or even clean. So I'll just allude to this. Look forward to it in the next one, and because we've gone longer than I was going to do this in a half an hour, and now it's not a half an hour. The very thin stocks that aren't part of any ETFs or market averages, so like non-S&P, non-Nasdaq 100, thin stocks without options on there, that volume is going to be, and that aren't super low price, super low price, or is going to be more accurate, in my opinion, than something that is part of the Dow or part of the S&P and part of the Nasdaq and the Nasdaq 100 and a bunch of key ETFs. And that is going to have a lot more noise in it, and that has options. Obviously, all those would have options, and especially daily options and stuff that make it dirtier. Or really, if you were going to look at and trade foreign stocks on foreign exchanges that are truly not, like, they don't have ADRs attached to them, that is going to be cleaner. But most people aren't going to trade those, because then you're going to take other risks involved with those. But that is going to be more on the clean side, because for a while there we did trade international. There was some of us traded international at the firm, and so I was trade in various countries like Hong Kong and Europe and I think Australia and a couple other places. And so you have the time zone thing, you have the currency thing, but those volume in there for the ones that were single listed, meaning they were only on their local markets, traded a lot cleaner than ones that were dually listed. So like, let's say a Microsoft is listed here, but it's also listed, you can also trade it in Europe. And then you can also, well, now you can trade leverage ETFs on those too. And of course you've got options and all that stuff. So much more ways to play the same thing. So we'll talk about that a little bit more, but kind of alluded to why right now. But let's summarize this last part, the consolidated tape. So the consolidated tape is either NYSE or NASDAQ. Really, you should combine them too. Total market, the way I would do it now would be a total market ETF that, or index, just create something that is everything this market cap weighted, whether it's NASDAQ or New York. Because that's another thing. It's like, you've got to, more times, the more ways you look at this, the more problems there are. So back in the day, there's NYSE were thought of as kind of your old school stocks that have been around for a long time, and NASDAQ were your young and up and coming stocks, and these were your riskier ones, and this was your like slow pokey ones. And now it's totally changed, and it's like, whoever, does NASDAQ give them a better deal or New York give them a better deal to list there? It's mixing and matching, so it makes no sense at all why you wouldn't combine total volume if you're going to look at it. And then you don't want to look at total volume, but not total volume of price. So then you would have to look at there are some ETFs that, like I think Vanguard's got on, like the total, and other people that their total market, but people don't look at that. So there's also the psychology of, okay, is the S&P breaking through its 50-day or its 200-day? Is the NASDAQ going into new highs or not? So you wouldn't want to interpret the price and volume on something that is just theoretical, or that only a few people are looking at, because you're trying to interpret mass psychology. So you're trying to look at what is the Nasdaq doing? What is the S&P doing? What is the Russell doing? And so there's no perfect way, but if there was ever a broad-based index that was everything and did it in dollar volume, that would be a cleaner way of doing it, but still, it would still be problematic. I still wouldn't use it. But if I was going to do any of them, but other than that, it's just silly. I mean, it's like totally silly. We use now New York volume for the S&P to determine if it's a follow through or distribution, but your biggest companies in there are now on the Nasdaq. So, like, why? Like, it doesn't make any sense, but it's just this thing that happens slowly, over time. And there isn't a better way to do it. So you just stick with that. But really, you want to look at S&P volume, like tally up all those stocks, but that's not what everyone else looks at. And so it's a lot of this stuff becomes self-fulfilling. So you can see why I was reluctant to do this, and people just say, "Oh, well, just tell me in 5 minutes or less why you don't use volume." Well, like, no, it's not going to happen because it can't happen. And even if I was like didn't go off on tangents, this would still be hours long. If I was just to the point, it would still be hours long. But with that said, I think we should wrap it up for today and pick this up the next time we do one of these on the dirty volume. Hopefully you guys are learning from this. And again, I just wanted to document it. And I just want to say I've read the comments that have come so far from my first volume episode, and I just love them. I like so many nice people with nice comments, and it really means a lot to me that the people who have watched it and have valid questions. If you take no offense to valid questions, just don't say it doesn't work. Say, "Well, I don't think it works, Mike, because we can have a debate, a conversation, or I can just think about that. And let me tell you, that's the way to do it, but not like, oh, well, so and so said this or whatever. Like, dude, that doesn't fly with me. So you don't have to agree with this. You really don't. In fact, you shouldn't. If I say like, oh, volume doesn't matter, and you're like, oh yeah, Mike says volume doesn't matter. No, you're wrong, man. Like, think through it yourself. You got to come to your own conclusions. I don't care who says something. Think through it to make sure it makes sense, whether you respect them or don't respect them. There are people who say things, and this is what I've got to watch, because there are a lot of people who say things that I just really don't, just say I don't admire them, and they'll say something, and my instinct is like, okay, if they say up, then I want to say down. But really, it should just be, what do I think? And that's one of my problems that I have, and why I try to not know what other people are doing or think about the market, because then I'm more likely to think the opposite of them just because. And that doesn't make any sense either. So we all have our problems that we have, and that's why it's better to just kind of be as isolated as. I didn't even want to know what Bill thought, because I was thinking too, it's like, okay, well, if Bill thought it and I do it, how am I going to replicate that? And that would be a question that we would, a topic that would come up all the time at workshops. When I taught workshops with them, at the end of the day, when we would do Q&A together, people would always want to know, oh, well, what was Bill in? What did Bill like? Well, Bill could be in something and he could have bought it 3 months ago, and now he's getting ready to be out of it. So you don't want to know about that. But let's say he just bought something that Friday and we were doing the workshop on Saturday. Well, you don't want to know that either, because he could be selling it on Monday. And so unless you're going to know when someone is going to sell something, knowing what they're buying doesn't do you any bit of good. Or there would be times where it would be a workshop on Saturday and he would be talking negative about something. Come next Tuesday, things had changed and we're in there buying it or adding it to our list and then buying it after that. And that was the right thing to do. So learn from people about how to fish, but don't rely on them for fish. Or if you're vegetarian, don't eat the fish. You know what I'm saying? Like, you can pick up what I'm putting down. So with that said, thank you for all of that stuff. Now it's time for you guys to do what you need to do. Okay, my Venmo account for this week is I fooled you again. You don't have to pay me.com. What you do need to pay me is in a kind act to somebody or something. No money involved. In fact, I want to have this where don't want people to, because I really am like, okay, at some point someone's going to say, oh, okay, I donated X number of dollars to whatever cause. That's great. If you can do that, just do it and do it. Be quiet about it, because I don't want other people who don't have the money to contribute to something to do that as their act of kindness. A true act of kindness, because someone who's worth $100 million and they give $100,000 to a cause or something, I'm knowing people like that or more. That's no big deal to them, but they expect, oh, I would give $100,000, so I should get this in return, recognition or whatever. No, like if someone is worth negative net worth and they give $5, that's way more meaningful than the person who had $100 million and they gave, 100,000. So not money, but kindness, the act of kindness. Open a door for someone. Just get in a habit of opening a door or leaving a door open for someone, as simple as that, or just doing something nice for someone or an animal, or if you see some insects that they don't have to be killed. I get it. Like if your house is being invaded by something and you've got to take care of that, well, that's a different situation. So I'm not saying like let your house be invaded by ants but if there's a way that you can avoid those ants from getting in your house, that's one thing. Or you're outside, like there's an ant hill, just step around it. So it's one of those things. And so you don't have to be so extreme, but you want to just say, what if you come back in a future life as something? Maybe you don't believe in that, and that's fine. I'm not saying I believe in that, but let's just say anything is possible, because you don't know, nor do I, nor does anybody, what happens. Do you, would you want to be treated that way? And all life is precious, all life. So be kind to somebody. That is your job from watching one of these, because I do these for two reasons. I do to help you guys, because I want to have a free outlet that I can take whatever amount of time that I want to explain something without worrying someone else has to edit it. I have to edit this stuff. I just leave it as is. I will remove things like my ands and ums or things like that. Or if I have to edit something because I've got to get up to go grab a drink or something like that. But I don't edit things out. If I make a silly remark, I leave it in there. What you see is what you get. Um, Maybe it would be better. Maybe more people would watch if I edited it for real. But I'm doing this all on my own. But the real reason why I'm doing this is I wanted to have something for my kids if they ever decided that they were interested in trading, and for some reason I wasn't available, for them to learn from me, not from a book, not from a different person. Or really what's more likely in the cards is when they have kids one day, for those kids, I'm hoping that however many grandkids or however many kids they have, that all of them want to trade and they watch the Webby Rambles on 20, 30 years from now and learn. So hope you guys are doing well. And with that said, until next time, peace out.